Hello, everyone, and thank you for the invitation. I'm Linda-Eling from the MSCI Sustainability Institute. Our team works at the intersection of capital markets and sustainability research. And so from that vantage point, we have a fairly unique lens on how large global investors are actually navigating this current moment. And the moment, as we all know, is one with political headwinds, growing regulatory scrutiny globally, and the more skeptical tone generally around sustainability-related claims. So the question I get the most often is, are investors pulling back from sustainable investing? And I think a yes or no response is, of course, too simplistic. So what I'd like to do is to share with you today what we see in terms of changes in investor behavior. And I'm going to focus on three themes: reallocation, relabeling, and a renewed focus on financial materiality. So let's start with the basics. So capital isn't leading sustainability. So despite the narrative on an ESG retreat, investor allocation to climate and sustainability strategies actually remain very substantial. At the end of 2024, the assets that are tracking MSCI's climate and sustainability indexes surpassed $1 trillion. And that's up from about $850 billion the year before, as you can see in the chart that's on the far right-hand side. Now, if we turn to looking at fund flows, not all strategies, of course, are gaining traction equally. According to our quarterly transition finance tracker, which is a report that our institute publishes every quarter, climate-themed funds that are publicly traded have continued to attract inflows through the first half of this year, reaching about $600 billion in assets. And within these climate funds, what's been growing the most are those strategies that target the energy transition, which the industry often refers to as transition funds for short. And those have really been rising quite strongly and now make about 40% of climate funds. So that's on the side of publicly traded funds, which are on the left-hand side. And then on the side of private assets, we're also seeing quite significant momentum. So the chart on the right that you're looking at uses data from MSCI's private capital database, which covers over 14,000 infrastructure, real estate, private equity, and private credit funds. And from this database, we've been able to identify that climate-themed private capital now stands at around $130 billion in assets. And what's notable really, when we compare the public funds and the private funds, is differences in sector exposures. Private funds are much more heavily tilted towards power generation sector than public ones. And this is really where a lot of the renewables infrastructure and transition capital is going. So while public markets, of course, remain active, as you can see that it's growing, private capital is really increasingly where the action is for decarbonization investments. Staying with asset flows, a more recent development that we've been seeing is a change in the geography of climate investments. So since 2018, U.S. listed companies have consistently been overweight in climate funds, making up about 67% of holdings. So that's 2/3 of climate funds are in U.S. companies. That's a larger weight than in the overall MSCI broad market index, where U.S. companies do make up a substantial weight, but around 58% of the market cap. But that has also been changing. So just in the first half of 2025, the share of U.S. companies in climate funds have actually dropped by about 10 percentage points. So putting that in context, the weight of U.S. companies also fell in global benchmarks, but by much less. So we estimate that about 6 percentage points of that shift reflects active reallocation, so away from U.S. and towards companies that are in Europe and Asia Pacific region. And the rest is actually due to market movements. So as you can see in this chart and the lines at the top, this marks the first such shift in at least 7 years. So if we want to understand where investors are actually headed, a good place to actually look is what they're asking us as one of the largest providers of climate and sustainability data and analytics, what they're asking us to support them in terms of their investment strategies. There are two areas where we've been seeing the most consistent demand for new analytics over the past 12 months. First is tools that help map opportunities in the energy transition. There's no longer this idea that there's one global energy transition that's happening all at once. Instead, we have different sectors and different markets which are facing quite different tailwinds and headwinds, both in terms of the policy incentives and policy pressures, as well as in terms of technology adoption. We can just think about what's happening with EV adoption, for example, globally. So investors are really digging into the relative company readiness, based on where companies are operating and how far along new technologies are in the transition in those markets and in those sectors. They really want to know which firms are likely to gain market share in this new energy system. A second area of fast-growing demand is for analytics related to physical risk and corporate resilience. That includes geospatial data that is linking real assets to issuers, and better models for assessing exposure to dozens of growing hazards like wildfire, or floods, or heat stress. More broadly, we see investors starting to really look for investment opportunities in adaptation and resilience, not just the risks. There are products and services where spending by households, spending by businesses and governments are likely to increase significantly over the next decade in order to cope with the growing climate physical risk. Anything from cooling infrastructure to weather analytics, these are all investment opportunities. And if you're interested in this theme, I would point you to the Global Adaptation and Resilience Investment Working Group, GARI, that is the acronym for this investor group with whom our institute has also done some work exploring this investment theme, as well as recent reports from Singapore's sovereign wealth funds. GIC, for example, has estimated in a report published earlier this year that adaptation investment opportunities could reach $9 trillion by 2050. Temasek and BCG also published a great report that I can refer you to that mapped out opportunities that are investable now for private equity in resilience and adaptation solutions. So these are still very early stage frameworks and strategies for most investors, but they're really attracting quite a lot of attention, and I think growing capital from a broad section of global investors. Let me now turn to the next theme we've been seeing in terms of investor behavior, which is relabeling. And here I'm really talking about relabeling of sustainable funds, which has been driven less by US politics and much more by regulatory changes and uncertainty in the EU and its sustainable finance regulations. I'm going to share a few findings from analysis by my colleague Kishan Kangadia and his collaborators who have been tracking closely European fund flows. And what you're seeing on this chart is some of that research, and it shows that fund managers have been very busy lately relabeling their funds. So more than 260 Article 8 and 9 funds have been rebranded in the first quarter of this year, and that has ramped up even more dramatically in the second quarter, as you can see. This is all part of a broader trend that has seen funds with 600 billion euros in AUM renamed in the last 15 months. Now, what is driving this? Well, one catalyst was the European security regulator, ESMA's fund naming guidelines, which required a specific set of exclusions if you're going to be using terms like climate or ESG in the fund name. Now, if a fund didn't apply all the prescribed exclusions, then the choice is to either relabel or to apply the prescribed exclusions or some combination. And now what's interesting is that all of this relabeling activity that's been going on did not actually have much to do with what's underneath the hood. So analysis that we did on the disclosures of fund prospectuses showed that nearly 90% of the funds that have been renamed during our review period has remained a sustainability product, regardless of whether or not they carry that in the product name. We also found that following relabeling of a fund, it didn't actually trigger outflows. So we're interpreting that to suggest that fund providers actually remain quite committed to their sustainable investing approaches and strategies, regardless of their ability to label a fund for marketing purposes, and also that investors in these specific funds may be looking deeper at the underlying portfolio characteristics and maybe care less about the use of specific terms. Now, that said, all of this uncertainty has taken a toll. In the first quarter of this year, the number of new Article 8 and Article 9 funds launched in the EU fell 37% from the previous quarter. So that is the lowest level in over a year. And I think this kind of uncertainty does mean that capital pauses and waits to see way more uncertainty. So let's move now to the third and what I would consider the most consequential theme, which is a renewed focus on financial materiality. This is something that we see across all investor types, from large asset owners to smaller impact-oriented fund managers. There's simply a growing appetite and demand for rigorous quantitative evidence about which sustainability approaches have delivered financial value and under what kinds of conditions. And one driver of that interest is we continue to see performance divergence across regions. On the left, what you're seeing is performance results for over a decade. In Asia and in Europe, we've consistently seen that top ESG-rated companies have outperformed bottom-rated peers within their sectors. That's the top two lines that you're seeing on the chart on the left. And that pattern has been true for all regions, but weaker in emerging markets and weaker in North America, which are the bottom two lines. Now, on the right, we focus on just the most recent period. And what we did was also isolate the pure ESG factor contribution, so controlling for all the other risk factors, the borrower risk factors. We use here the MSCI's regional risk models for this analysis. And since early 2023, ESG factors have added value in Japan and in emerging markets ex-China, while U.S. exposure, which is the dark green line you see, has deteriorated. Now, this interest in materiality is also being fueled by improvements in the data. We now have enough consistent long-term history of granular data to pinpoint which specific sustainability issues have had the strongest link to performance by sector. And so this table that you're seeing summarizes results from our research looking at performance attribution over 5, 10, 15 years based on the underlying data that's disaggregated from the MSCI ESG ratings and across the thousands of issuers globally. You're going to notice that there's not one issue that is universally material across all sectors. But within sectors, you can pinpoint a small cluster of issues that have mattered the most. So, for example, in consumer staples and industrials, business ethics have really stood out. So top quintile companies on managing their business ethics were over 40% less likely to suffer a catastrophic share price drop, defined as 50% or more, compared to bottom quintile peers. In consumer discretionary, just the one issue of human capital development alone has contributed over 7% per year stock-specific outperformance for the top quintile performers on this issue versus their sector peers in the bottom quintile. And for materials companies, really not many other issues mattered as much as managing their toxic emissions and their waste, as well as carbon emissions. So together, those two issues contributed to outperformance of the top quintile companies over their bottom quintile peers by over 5% annually. We've also published findings on how ESG factors relate to the cost of capital and credit spreads and how those relationships vary across sectors and regions. And this is all very much ongoing work because our clients and the broader market are continuing to test and refine and challenge their investment theses around using sustainability to generate value. So to sum up, investors are reallocating capital with greater attention to transition readiness and physical risk resilience, and funds are being relabeled largely for regulatory reasons, but the underlying strategies remain fairly stable. There's also a strong shift towards evidence-based analysis of how sustainability drives or detracts from investment value. And on this last point, if we step back to reflect on this moment, I think investors are returning to the core premise, which is that attention to externalities can drive long-term value, but they're now more clear-eyed about the trade-offs, about where impact and performance align, where they may not, depending on sector, depending on region, market conditions, and time horizon. So investors will continue to debate, I think, which approaches and strategies will be the most effective or less effective to deliver both financial and societal outcomes. Now, what no one is arguing about is the value of having more information. So investors have gotten used to more and better quality sustainability data. It's become part of the information set that they use to get a holistic and forward-looking view of a company's management quality, about the company's adaptability to emerging issues, whether that issue is resource constraints or technology shifts or physical climate impacts. So asking investors now to go from an era where they can expect more transparency on their investments back to the dark ages of having less transparency or no transparency to form their investment views, I think that's a genie that's going to be very hard to put back in the bottle. Thank you.